It beats market expectations, but still, China's economic growth continues losing steam. It underscores the need for policymakers to move swiftly in executing the powerful stimulus packages announced last month. The country's third quarter GDP growth rate slowed to 4.6% on year. From previously 4.7% in the second quarter, it marks the slowest pace of growth since the first quarter of 2023, when China emerged from COVID lockdowns. However, China's September activity figures showed a broad-based improvement after Beijing unleashed a swath of stimulus measures to support growth. So retail sales, industrial production, and fixed asset investment figures, they all came in above expectations, while the property sector investment continued to shrink. To unpack this data is our China correspondent Olivia Seong, who is speaking to us live now from the Marina Bay Sands Convention Center, where the annual Future China Global Forum is underway. Ollie, what has been the reaction to this so far?
Well, Olivia, it's kind of noisy where we are, perhaps emblematic of the chatter and discussion that's going on about the world's second largest economy. And here with me to unpack all that data and what that means moving forward, I'm joined by OCBC economist Tommy Xie. Tommy, let's just jump straight into it. There's a lot to talk about. You've been watching this closely. What's your reaction to these latest figures? Does this pile added pressure on Chinese policymakers to do more to boost China's economy?
Yes, I mean, if you look at the headline number, 4.6%, that was lower than the Q2 number. So we do see the deceleration of the economy growth in China right now. So that's really explained why China came out so many measures in the past few weeks. But if you go down to the details, I think some of the details are still quite encouraging, I would say. You look at the retail sales. Retail sales was stronger than expectation. So we are seeing the rising demand from the retailers to buy the cars, thanks to the government policy. I think same as the production. In fact, the production is still quite resilient, maybe because of the stronger demand from the external demand. So I think we are still seeing the external demand will be still the key driver to China for this year. So overall, I think we are seeing the resilient external demand, but we start to see maybe some kind of a picking up of the domestic demand. So that should be the good news for China to see that numbers.
You mentioned that there's a pickup, but the issue has always been in how sustainable that momentum can be, given the stimulus measures that we've seen and persistent concerns about the weak domestic demand. Is it enough to prop up the economy?
Well, whether it's enough or not, that really depends on how effective this round of the stimulus is. So we are seeing this round of stimulus actually is quite powerful, I would say. Some of the stimulus is really trying to address the underlying problem of this weak consumption. For example, when we talk about consumption is a function of three things. Number one is your income growth. Number two is your income expectation. Number three is your wealth effect. So before the recent rally of the equity market, there's no wealth effect in China, not from property, not from equities. That's why I think with more support to the equity market, I think this rally of the equity market become increasingly more and more important. If we can create a wealth effect from the equity market, that may translate to the stronger consumption in the future. So which means how long the rally of the equity market will be also important to decide how sustainable is the recovery of this domestic demand.
Another major drag on China's economy has been its property market, right? And yesterday we saw the housing minister come out and he did say that he believes that the market is bottoming out and that the data for October should be quite positive. But here we are seeing that housing prices have continued to drop in September, sliding 5.8%, and that's a bigger drop rather than what we've seen in August. So what is your assessment of what's to come for the rest of the year?
Sure. I mean, talking about the property market, we are seeing the uneven performance. I think for the tier 1 cities, we start to see some kind of the stabilizing. Of course, for the smaller cities, they are still suffering from some kind of the rotation of the capital from the smaller cities to the big cities. But I guess one of the key challenges right now for China is still how is China going to rebalance the supply and the demand. It seems like it will still take some time, maybe another half year to 1 year for China to eventually to reach this equilibrium level for the supply and demand. But in the near term, I guess the market will still facing quite a number of challenges. But one of the good data we are seeing, in particular in terms of the high frequency data, we do see some kind of the rebound of the property transaction around the middle of October. So that gives us some kind of a hope, some people start to buy. So that should be the good news. We will continue to monitor in terms of this high frequency data.
Looking at this data, though, one of the things that we're looking out for this month is that meeting by China's top legislature's standing committee, where, if any, they could approve more fiscal stimulus. What are you expecting now that we have seen this data, which points to clearly there's still challenges that need to be addressed?
Yes, I think the measure will become from two angles, both monetary and the fiscal side. So I think for the monetary, it could be the low-hanging fruits. So it's easier for China to decide to cut the interest rate or maybe cut more triple Rs, which I think is quite likely in the last quarter of this year. But of course, the key is really the fiscal stimulus. So how can China deal with this hidden debt problem? So they has already mentioned they're going to issue the debts, but in which way? Will that be issued by the central government, or will that be still issued by the local government? So the impact could be quite different. So there's a lot of still details are missing. So I think market is still waiting for the details. But of course, one more thing we can hope to see is, are we going to see more measures to support the domestic demand, in particular consumptions? So this is something so far is still a bit missing right now. So we are seeing there's a lot of measures to deal with the hidden debt by the local government. We are seeing a lot of measures to safeguard financial risk, but not much on the domestic demand part. So this is something I think hopefully we can see more in the coming months and the quarters.
Speaking of the coming months, we've seen the stimulus measures, this policy shift from the end of last month, and government agencies coming out to try and show confidence, boost confidence rather in China's economy. Moving forward, what is your forecast for Q4 and the full year for this year following these stimulus measures?
Yes, I mean, based on the first three quarters, we got roughly about 4.8%, which is slightly below the around 5% kind of a target. But I do see China is quite practical, to be honest. If you look at the announcement from the NDRC recently, they do bring forward front-loading like 200 billion investment for the last quarter of this year. So with this front-loading, then with a little bit leverage up from the banks or from the private sectors, I think that may potentially to fill the gap in terms of the growth for the last quarter. So I do see the hope for Q4 GDP to grow above 5%. I mean, hopefully we can reach about 5.2, 5.3 kind of the levels. That will help China to reach around 5% kind of the growth targets.
Well, thanks so much, Tommy. Clearly a lot to look out for, and expectations very high.
Yes.
Moving forward. We'll have to leave it there, but thanks for your insight.
Thank you very much.
I've been speaking to OCBC economist Tommy Xie. For now, back to you, Olivia.